When everyone on YouTube, including your dear Aunt Sally, is calling for a stock market crash or recession, it may be time to think about those boring, stable, consistent companies that pay cold, hard cash on a monthly or quarterly basis. Just for you being you. Seriously, you can literally go to the beach and just sip Mai Tais all day. Oh look, a carrier pigeon has just come to give me my monthly dividends. In today's video, we will discuss the top 4 dividend ETFs to buy now. They will range from the safest, lowest yielding dividend ETFs to the higher risk, higher return dividend ETFs. The top dividend ETF we have is the Schwab US Dividend Equity ETF, or ticker symbol SCHD. This is a great steady ETF because it only invests in stocks that have at least a 10-year track record of paying out dividends. It tracks the total return of the Dow Jones US Dividend 100 Index. The dividend yield is currently 3.10% with a low cost expense ratio of 0.06%. It is currently $72.61 with a 52-week range of $69.86 to $82.48. Net assets are $36.7 billion, so very steady, and we have seen a 100% increase in the stock price within the last 10 years. It currently has 104 holdings, and top holdings include Merck at number 1, Verizon, Amgen, Pepsi, Coca-Cola, IBM, and Home Depot, so very well-known brands. It has a 21% exposure to financials and a 20% exposure to information technology, IT. Its portfolio is mostly allocated to financials and information technology. Next, we have exposure to consumer staples, healthcare, and industrials. SCHD contains companies that mainly have a large market cap, with 61% of its holdings having a market cap of more than $70,000 million. Larger market caps usually indicate older, more established companies that have consistent revenues with a steady dividend. So if you're looking for something safe and consistent as far as dividends are concerned, this is a great option. Looking at its dividend history, we can see a steady increase in dividends throughout 2013. It started at a 22-cent dividend in 2013 to 24 cents in 2014, 27 cents in 2015, 32 cents in 2017, 35 cents in 2019. Notice the steady, slow increase, which is great for dividend investors. And it even increased during 2020, and it was non-stop, and is currently at 70 cents in 2022. This shows how resilient the passive income is for shareholders. With a great return on stock price and a steady dividend, ticker symbol SCHD is one of the best recession-proof dividend ETFs on the market. The second dividend ETF is Vanguard's High Dividend Yield ETF, ticker symbol VYM. This tracks the FTSE High Dividend Yield Index, which measures the investment return of companies with high dividend yields. This is a great ETF for investors who want higher cash flow from dividends that are higher than the S&P 500. There are no real estate investment trusts or REITs in this ETF, so if you're looking for a REIT, you will have to buy individual REITs along with this. And it holds companies with mid and large market caps that are classified as value stocks. The dividend yield is 2.72% with an expense ratio of 0.06%, just like ticker symbol SCHD, although this has been on the market for a little bit longer. It is currently $103.04 with a 52-week range of $98.63 to $115.66. Net assets are $58.82 billion, and the stock price has increased 66% in the past 10 years. If you're looking for a highly diversified ETF, this is a great option. It currently holds 443 companies, so about 4 times more than SCHD, which is one of its pluses if you're looking for diversification. Top 10 holdings include Johnson & Johnson at number 1, ExxonMobil, JP Morgan, Procter & Gamble, and Chevron. So we have a lot of well-known names combined with oil and pharmaceutical companies at the time of this recording. I also find this interesting because Warren Buffett has been aggressively buying oil stocks as well. Financials and healthcare are the top sectors in this ETF, with an exposure of 20% for financials and 14% for healthcare respectively. Other prominent sectors include consumer staples, energy, and industrials. It currently holds only U.S. companies. Looking at its dividend history, we can see a similar happily ever after story since 2013. In 2013, the dividend was 41 cents. In 2014, it was 40 cents. Little bit of a dip, but not that bad because it made up for it in the rest of the quarters, and it pays quarterly. 2015 was 46 cents, 2017 was 56 cents, 2019 was 65 cents, and while 2020 was a bit rocky, we did see an average dividend increase still. And currently in 2022, the dividend is 84 cents. So again, it's recession-proof resilient. I would definitely say that SCHD and VYM are like twins, and they are both good options. If you're looking for a dividend ETF that is steady and you can buy and hold forever, this is a great option. Comment below if you prefer VYM or SCHD. The third top dividend ETF is the JP Morgan Equity Premium Income ETF, ticker symbol JEPI. Unlike SCHD and VYM, which pays dividends quarterly, this ETF pays cash flow monthly. This is a very interesting ETF because it follows a very different strategy than SCHD and VYM. It selects stocks on a proven bottom-up research process with stock selection based on proprietary risk-adjusted stock ranks, which is just legal jargon for we choose great stocks but won't tell you our secret sauce, and uses options overlay that flexibly adjusts with the current market. So it uses stocks and options to generate its attractive current yield of 7.5% dividends. JEPI is an actively managed fund with an expense ratio of 0.35%, which is high, but the 7.5% dividend more than makes up for it. JEPI's main goal is to seek current income while maintaining prospects for capital appreciation. So, while it's looking to generate income for dividends, it's also looking to grow capital. Its main strategy is a bit different than a covered call strategy like ticker symbol qyld, because it seeks to provide the majority of returns associated with the fund's S&P 500 benchmark index while exposing investors to less risk through lower volatility and still offer incremental income. In order to do this, they invest in stocks with a lower volatility than the S&P 500 and ELNs, or equity-linked notes. This basically means it seeks to provide investors with S&P 500 returns with lower swings in stock price and monthly dividends that are steady, and may invest up to 20% of net assets into ELNs, which are basically like strip bonds or a debt instrument where the principal and regular coupons are sold separately, with a call option on a specific security. JEPI is currently $56.12 with net assets of $9.83 billion. It has a 52-week range from $52.54 to $63.67. Top 10 holdings include Progressive, Bristol-Myers Squibb, which just had a 52-week high on Friday, AbbVie, and Hershey, along with ELNs and call options. Its holdings are mostly exposed to the healthcare and consumer staples sectors. Healthcare accounts for 12.8% of its portfolio, while consumer staples account for 11.9% exposure. Since JEPI is a new kid on the block, its dividend history is brief. In 2020, the dividend was 49 cents. In 2021, it was 26 cents. And currently, it is 51 cents. Of course, we had a few special dividends, so this varies a bit. While it did pay a dividend throughout 2020, the dividend has fluctuated and returns have been more volatile than SCHD. While the dividend has ebbed and flowed each month, the 5-year average dividend yield is 7.51%. Now, this 7.5% is average, and it is what I'm expecting for the next years to come because I believe that management has a very solid process, and I believe that 2020 was kind of a fluke year, and that is when they started. If you're looking for monthly cash flow, a high dividend, and reduced volatility, this is a great option. Just be aware the dividend may fluctuate monthly, but hopefully stay as an average of 7.5% or increase. And this ETF is a bit newer, so we don't actually have a long track record on performance of the stock. The last top dividend ETF on this list is the Global X Nasdaq 100 Cover Call ETF, ticker symbol qyld. This is a cover call dividend ETF that owns all of the stocks in the Nasdaq 100 and sells at-the-money call options on the Nasdaq 100 every month. This is in order to maximize option income received. Selling covered calls is a great strategy that I personally use to generate additional income on my dividend stocks. It is an incredibly low-risk option strategy, with the only downfall being investors may not receive as much capital appreciation as investors that just own shares if these stocks unexpectedly rocket to the moon in share price. QYLD is currently at $17.62 with a dividend yield of 12.08%. Net assets are $6.85 billion with a 52-week range of $17.01 to $23.15. Since it tracks the NASDAQ 100, its portfolio consists mainly of technology. Top 10 holdings include the FANG stocks with Apple, Microsoft, Amazon, Tesla, and Google. QYLD's dividend history, while volatile, has paid dividends every single month. In 2014, the dividend was 25 cents. In 2015, it was all over the place from 15 cents to 23 cents. In 2016, it was 12 cents to 22 cents. From 2018, it was higher with 17 cents to 24 cent range. And 2020 was fairly steady around 19 cents. Currently, in 2022, it is at 17 cents. QYLD dividend fluctuates from 13 cents to 25 cents and is quite volatile. While the yield is very attractive, the dividend swings may be too risky for your portfolio. Investors also must be aware of the capital appreciation. QYLD is currently down 30% after 10 years on the New York Stock Exchange. Capital has steadily depreciated throughout its history. If you're looking for dividend growth, this is not the right ETF for you. Investors must also understand this is a riskier asset than all of the other ETFs due to its underlying assets. The NASDAQ 100 is very tech-heavy, and therefore it is not a great hedge against inflation, quantitative tightening, or higher interest rates. If you are looking for steadier dividends and possible increases in capital appreciation, ticker symbol XYLD, which is the Global X S&P 500 covered call ETF, may be a better option for you. If you just want a very high dividend yield for monthly cash flow and believe tech will continue to dominate the market even with higher interest rates, this may be a great ETF for monthly dividends. Now you know my top personal 4 dividend ETFs that every investor, I believe, should have in their portfolio. You should choose at least one that you love. I have all of those in my stock portfolio, and I will be doing a reveal sometime soon. Just comment below what stock you would like me to go over next, and I wish you very well. This is Supergirl Investor here to save the world and make you wealthy, and hopefully you learned a little bit. Please like, please subscribe, please comment, all the things. And I just hope you have a very wonderful week, a safe, healthy week, and let's crush it and make some money and have all parents in yachts by 2025.